So what I tell people is if they buy a short-term rental or if we do a cost segment on a short-term rental for that year, you for sure need to make sure you operate it as a short-term rental and meet the 7 days or less. In other years, if it's just breaking even, it's not that big a deal. If you're a long-term rental or short-term rental and you're like a break even or you're making a profit, not a big deal. But in the year that you have the big losses, you want to be qualified to take those losses against the other income. So in that year, it's very, very important that you meet these short-term rental rules. That's one of the exceptions to let passive activity losses flow to offset your other income. I have
Mm,
had clients come and tell me that, their losses are offsetting their other income, and you look at their tax return and they're not. So people oftentimes think they're doing things one way and then in their tax return they're not. You have to do some stuff to make all these things flow right. And then the second way that's most common to make these passive activity losses flow to offset your other income is to be a real estate professional. So for realtors, it's great. They don't have to qualify for the 7-day rental thing. So for realtors, if that's their main job, they're already a real estate professional. To be a real estate professional, you have to have 750 hours per year in the real estate trades. And any realtor that's, full time or, a little more than half time is already meeting that requirement. So they're already a real estate professional. They have to have 750 hours and more hours than any other, job you do. So you're already a real estate professional. That means any losses you have on real estate is going to flow and offset your other income. Your real estate income's not passive, but since you're a real estate professional, your losses on your investment real estate is has the exception where those losses will offset your realtor income. So that's really, really important. I've seen that messed up on many, many tax returns too. I would say without planning, just the default way that our professional software works, and definitely the way like TurboTax works, and those kind of software, those passive activity losses are never going to offset, and people miss that all the time. You really have to know what the right answer is to get the tax software to do it right.
yeah. How can misunderstanding things like capital improvements versus repairs, how can they lead to unintended tax penalties?
Yeah, capital improvements are not deductible. They are deductible over a long period of time because they just increase the basis and they depreciate things. First, we want to look at, is it a repair or capital improvement? And if it's a repair, it's deductible in the current year. So if you're just repairing something that's already there, like your deck falls apart and you repair it, that's a repair. You're going to expense that right now. If you have to tune up the paint on the house, that's a repair. You're going to do it right now. You're going to expense that right now. There's some guidance. There's a code section, then there's some regulations called the repair regs, and then there's some court cases where people wanted to deduct something as a repair, but it really was an improvement, and the IRS challenged it, and the taxpayer either won or lost. And so from all that, from the regulations and from the court cases, we have a lot of guidance on what's a repair and what's an improvement. A repair is deductible in the current year, and an improvement is deducted over the whatever the life of the property is. So you very much want to be a repair. Now, if you determine that it's not a repair and it is an improvement, then you want to look at what category, because right now we have bonus depreciation. So if it's the kind of improvement that qualifies in the 5, 7, or 15-year categories, you can take bonus depreciation and expense that right away.